Welcome everybody to Hardman Talks. My name is Keith Hiscock from Hardman. I'm pleased to be joined today by Milan Radia, who will be talking about the technology sector. We're going to consider what's happened in the last 5 years, what's the sort of things he looks for in companies, how do investment professionals assess the sector, what he's hearing from investors right now, how different the sector might be in the next 5 to 10 years, and then finally, what's the value of research. But before we get into that, Milan, can you give us a quick potted history of your career, please?
Good morning, Keith, and thank you for inviting me to participate in this series of talks. I certainly think the global technology sector is in the headlines at the moment, so this is probably a timely discussion at the moment. In terms of my background, I knew from a pretty early age that I wanted to work in financial markets. This probably started around the time that my father was dabbling in the initial privatizations and other stocks and shares. And after university, my first job therefore was in fund management, on the buy side, as we call it, at Prudential Portfolio Managers, where I joined the UK equities team. And as you might remember, they certainly had the largest block of funds in the UK market at the time. So there was a queue of management teams every week coming in, dozens of companies coming in every week to talk about their prospects, issues, opportunities, in an effort to persuade the company to either remain a shareholder or become a shareholder. So that was a pretty intense period of education, watching these CEOs discuss some of these fundamental strategic elements, and really stayed with me thereafter. Over time, I took on growing fund management responsibilities, and by year 5, I was responsible for around £350 million of unit trust money, including some of the special SITs and distribution trust type funds, and actually a notable fund launch there in '98. Was a Scottish amicable ethical fund, so one of the early examples of funds designed to invest in sustainable and ethically sound companies and propositions. Certainly a bigger area now. And in '99, just as the tech boom was heating up, I was tempted to move across to UBS Warburg on the sell side, one of the kind of large investment banks in the city. And I started work as an equity analyst. This was initially focused on telecoms companies, and then I shifted focus a little bit to software, internet infrastructure, and data centers.
That was a pretty exciting time to be around in your sector.
Yes, it was a pretty fascinating time to be immersed in global technology. I think it was around that time that the world realized that some of these technology capabilities and themes that were emerging were really going to change the way that we lived and worked at an accelerating pace. But unfortunately, as we all know, some rather excessive exuberance led to valuations that were entirely unsustainable. Company fundamentals were entirely forgotten amongst this madness, and the crash that followed was a function of precisely this all being unwound. But despite the trauma of that period, I continued to focus on the technology sector ever since, working at a couple of other investment banks, and then more recently combining, writing research with Hardman with work for a large data center company on corporate development and related matters, which has given me a fascinating insight into how companies really work.
Okay, well, thank you for that, Milan. Let's go on to the first question, which is, what have been the main events in the sector in the last 5 years?
I think one of the core themes that we've seen, and this is going to be a secular theme that persists for many, many years, is accelerating digitization. And what I mean by that is the impact that computers, analytics, the way we use and collect data is fundamentally changing the way that we communicate, we work, we live, transact, obtain information. Just an example would be if you walk into a bank today, you're not going to find the traditional bank of individual tellers handling our queries on an individual basis. You're going to find a long row of machines which will deal with a lot of our cash requirements and payments and so on and so forth. So, the way we manage our money is fundamentally changed in a digital perspective, and everything's now happening through our apps and so on. If you look at the way we consume content, it's increasingly on demand. We are consuming programs and other content when we want to, in the way that we want to, on the device that we want to, whether that's Netflix, YouTube, iPlayer, Sky. And we're actually using a lot more mobile devices to access content created by other people. So that could be on TikTok or Facebook or Instagram. So the types of content that we're able to access and enjoy consuming have fundamentally changed. And underpinning all of this is much of data creation, generation, transmission. Every second, it's terabytes of data around the world. And so, as you might imagine, substantial investment is to going into the servers and infrastructure, data centers, where all of this content is stored, and into the subsea cables that are transmitting this data around the world at very, very high speed. So these are incredibly fundamental themes that, from a consumer-facing perspective, are very much changing, our lives fundamentally. And this is going to keep going, keep happening.
What about enterprises and the changes in tech in enterprises?
Yeah, there've been some equally important trends and fundamental trends in enterprise. And I would say actually some of these enterprise trends are a little bit earlier than what we see in the consumer markets. But let's take a couple of examples. Cloud. What we mean by cloud is kind of compute that's located outside of the four walls of the company premises. And what we're seeing are companies increasingly migrating their applications to the cloud. And this might involve abandoning a traditional application, for example, for customer relationship management, CRM, and moving to Salesforce, which is one of the leading examples in that segment, and also is one of the best examples of a software as a service company, a SaaS company. It might involve creating a private cloud where the company moves a lot of their confidential data and some of their proprietary applications into a cloud that's dedicated for them, but where the machines, the servers, live in a third-party environment, location. And as things start to overlap, which is really happening now, you end up with what's known as hybrid cloud, supported by multi-cloud. And so enterprises will be using some of these SaaS applications, some proprietary, some compute and analytics from Google, Microsoft, Amazon. And so they need to be able to use applications and capabilities from all of these different parties. And what we're now seeing, the real emergence of that kind of multi-hybrid cloud type environment, which is quite complex to manage, but is becoming the norm. And I think the second key trend is automation. I think enterprises are realizing that in order to be efficient and in order to deliver optimal customer service, they really need to automate a lot of their processes. So as an example, most of us will have encountered difficulties during the pandemic and the lockdowns in reaching customer service people at our telecoms operators, Sky, etc. And these call centers really struggled to deal with their call center lockdowns during the pandemic. Now they realize that actually that can be addressed. What they need to do is automate some of this. There are lots of conversational, for example, artificial intelligence tools, chatbots, that can handle a lot of these customer service inquiries and resolve them. The good platforms can absolutely resolve some of these issues without the need for any involvement by humans. So this kind of process automation, and that goes right into if you apply for a new credit card or a mortgage, more and more of that can be automated so that the process takes days rather than weeks to complete. So, and that's all good customer service. That's all stuff that will differentiate one enterprise which has been fully fledged in adopting this from another.
There's been a move, you already alluded to it, from just buying a piece of software outright to software as a service, a recurring revenue model, subscription. Can you just explain some of the issues around that, particularly the issues for companies and investors looking at them?
Yeah, it's an interesting topic, as today I think subscription models, building recurring revenue streams are seen as the norm. They tend to go hand in hand with on-demand consumption of content and services. And I think there's far less concern amongst management teams and investors about lengthy contract periods to lock in your customers and so on, which is the traditional model of thinking. And I can remember pretty well the nail-biting finish to fiscal periods that many of the mid-market software companies would face. It wasn't until the pre-close trading update was published that we would know whether sufficient license revenue had been booked in the period to avoid a major adverse impact to profitability. And the market would celebrate or lament accordingly, once the announcement was published, depending, and that would impact the stock price move, which would be sharp one way or another. So unsurprisingly, perhaps, investors have always tended to prefer companies with recurring revenue streams that afford a degree of visibility into the future performance of the company. It's an element of de-risking if you've got a high level of predictable revenue. And, you know, as an example, one of the first companies to really make this transition was a financial software company called Fidessa, which was acquired a few years ago, so it's no longer listed. But a nice example, it was a wonderful software company with a very strong position in equity trading around the world. And they bit the bullet soon after the dot-com crash and said, we need to migrate to a fully recurring revenue model. And they pretty much stopped selling upfront licenses as a result. Now, the short-term impact can be quite material because you're saying to companies, no, I don't want your money upfront. I'd like you to pay me over 4 or 5 years. And so you end up with an inevitable flattening of the revenue profile in the short term. And it's very important that that goes hand in hand with proper explanation to investors that this is why your revenue is flatter. It's not because we are, you know, struggling in the market or winning less business. But thereafter, what you saw was that the company maintained a material premium versus its sector thereafter in perpetuity until they got taken over. So the benefits of that transition were very significant, despite that kind of initial pain they suffered, relatively speaking, in terms of making that shift.
So you've been analysing companies in this space for many years, as you've told us. What do you look for when you're analysing a company? You know, what are the red flags that you've sometimes seen, and what are the things that give you a positive feel about the company?
Yeah, I mean, I tend to focus on both the fundamentals of the company, but also the broader industry context in which the company operates. So looking at the demand and supply landscape from a longer term perspective. So top down, I'm looking for clear secular drivers in favour of increasing adoption of the technology that the company is developing and selling, whether it's consumer facing, enterprise facing. And customer activity in this respect is, of course, a good barometer. So if you're seeing good adoption and good favourable early take-up, then that's clearly a good sign. But what are the alternatives? And are the rival offerings and trends that will likely ultimately displace the company in place? And over what time frame? So I'll give you a simple example of audio CDs, where they were followed by various high resolution formats looking to deliver better quality CD sound. They never really got up and running because actually they were completely usurped by on-demand streaming platforms such as Spotify and Apple. And that just changed the way people consumed audio content, and they never really got a chance. So there's a perfect example of the industry context, regardless of the superiority of that, you know, sort of higher resolution CD technology, never really getting off the ground. So from a company specific perspective, let's look at the, taking the technology application segment. The systems integrators play a very important role as advisors, implementation partners for these enterprises. And quite often what you'll see is that a chief technical officer within a company will more often than not turn to the systems integrators to give him or her advice on the right platform, how that gets kind of fitted into the broader picture of legacy, next generation apps. Most enterprises have a myriad of different systems that have been implemented over a long period of time. Particularly if they've acquired businesses, then you end up with a whole bigger mess of systems that all need to be knitted together at some point. So if you've got a good proposition, then typically you're going to see strong interest from the systems integrators. And there's another great barometer of that. You know, give you an example, Artificial Solutions is a company that we write on frequently. They're actually a relatively small company that sells actually the conversational AI tools that we were talking about earlier. They've signed up most of the largest systems integrators in the world. Deloitte and IBM and all these guys are all on the roster who are actively selling their software. So that, as an analyst, gives you a lot of comfort that actually this software does what it says on the tin and is delivering the efficiency and scalability benefits to the enterprises in which it's being implemented. To give you another example, let's turn to, turning to financials and give an example there. Organic growth is a critical component of the financial picture. If a company is growing mainly through, acquiring other businesses rather than selling its own products and services, that's a health warning in itself. So an example there might be Micro Focus, where I've been fundamentally negative on this company for 15 years and have often butted heads with management as a result of that. But this is a business that sells legacy software for older platforms such as mainframes, essentially managing the COBOL code that those mainframes would have running on them. And in the absence of demand for their products, they repeatedly acquired other struggling businesses in the same space and grew earnings by decimating the cost base of the companies that they were acquiring. So you'd end up with earnings per share growth because you're kind of reducing your costs and hoping that the revenue line would remain relatively stable. In fact, perhaps unsurprisingly, what you saw was the revenue started to disappear from these businesses because all the people that these end customers knew were being chopped out of the business, and there was no little reason for them to stay with these suppliers. And so some of the assumptions they made about maintenance revenue remaining intact proved to be fundamentally wrong. And this business is now firmly in the doldrums, having at one point been the largest software company in the UK. So focusing on profit growth, however defined, is not enough, because you've got to focus on the sustainability of that profit growth and look at it in a broader context. In this case, particularly through the lens of an acceleration in the decline of the relevance of these platforms, that Micro Focus was serving at an accelerating pace. And the last point I'd make on this is that profit doesn't always equal cash. And if that's the case, then this is another red flag. Something is amiss if you've got a big gap between the cash that's being generated on a free cash flow basis and the profits that the company's reporting. And I think the analysts on the Wirecard bandwagon, including a former colleague of mine, have learned that this the hard way, as the massive fraud has been exposed as the reason for the kind of growing misalignment over time between profitability and cash flow. So, and history is littered with examples of these type of companies where they got away with it for a time and eventually, ran out of runway to do that.
Okay, Milan. So let's move on to the next topic, which is how do professional investors value and assess the sector, and what sort of multiples do they use? What valuation methodologies are employed?
Yes, this is going to vary. All investors have got their own preferred approaches. There are standard measures, of course, and generally most people will start with valuation multiples and look at them both in the context of the historic multiples at which a company or sector has traded. They'll also look at these multiples globally and look at what peers around the world are trading at in similar industries. And that's difficult because there will always be national market differences in the way that companies are treated and so on. So you'll certainly see US companies in certain sectors having structural premium to what their European counterparts would trade at. But it gives you a picture, and typically people will use either enterprise value to EBITDA or market cap to earnings per share, so PE type multiple. But that's primarily a relative valuation tool. And then when you want to start getting to the intrinsic value, what is this fundamental value of this company? Ultimately, you've got to turn to looking at the future cash flows of the company and discounting it back and understanding, so this is how we calculate the present value of those future cash flows using what we call discounted cash flow models. And they're very assumption sensitive. And so you'll find that, relatively small changes to the discount rate at which you're applying to future cash flows, or some of those longer term growth rates or margin assumptions can lead to quite some significant changes in the implied valuation. So you've got to make sure that you're using sensible assumptions that stand up to scrutiny. But that's how you would go about typically. Most investors would agree that that's a good, valid measure of assessing the fundamental value of a company. But actually what you tend to find is there are points in time where people try to get too future looking and cast aside some of these valuation measures and really start to think about, well, what's the addressable market over the next 10 years? And let's take Tesla. Is it going to actually dominate the world in terms of its technology and some of these new batteries and autonomous driving options they have and so on? And so valuation gets forgotten. And that's what good professional investors will never do. They'll always, have one leg in the valuation camp looking at things pretty closely from that perspective, and that keeps them in the right place from a longer term investment perspective.
Okay, thank you for that. That brings us on to, what are you hearing from investors right now? What do you think is the short-term outlook for the sector? Obviously, we're not going to make any recommendations here. We don't do that, but it's talking thematic approach.
Yeah, I think technology investors have become quite cautious on the market at the moment. And I mean, recently, obviously, we're led to believe that actually there's been a lot of activity in the options market that has caused some of these spikes, but undoubtedly there's been a large inflow of retail money into some of the higher profile technology names as well. And so the technology funds are becoming quite cautious. And what you've seen is them selling down weightings in some of these names where they feel valuations have become overblown. Certainly from a 2 to 3 year perspective. Ultimately, you may be able to justify these valuations on a 10-year horizon, but that's not, is no excuse for holding stocks that you feel are fundamentally overvalued right now. But the predicament they face, of course, is that many fund managers are measured against market indices. And what you find now in the US in particular, or in the global benchmarks, these tech names represent a rather large weighting in these indices. So they have to be quite careful about managing their index weightings against some of these stocks as well. But look, I think the simple fact is, and we need to recognize that we are likely heading into a potentially quite prolonged global recession. And this is really going to manifest, I feel, once the government support programs in the short term have expired. Now, there are various efforts going on to try and sustain these, but at the end of the day, there's a finite timescale to which these support programs can be affordable for nations. And so they're going to taper off. And don't think any company potentially is going to be immune from the impact of that global recession. So valuations, to my mind, don't really reflect that outlook. And you can just see that pretty much valuations and headline market capitalizations in many cases have returned to levels that are pre-COVID. Yet you've seen quite significant cuts to earnings, and I think a lack of appreciation or lack of willingness to build in a recessionary outlook that could be quite prolonged over the next year or two. So there is uncertainty. Whatever your view is on that economic outlook, it's an enormously uncertain and volatile outlook. So buying stocks at the right valuation has to be the kind of key focus, I think.
So Milan, if we take a longer term view, 5 to 10 years out, what would your crystal ball be telling you about the sector?
I think technology is going to become increasingly important. It's already, in prime time, but I think the way that this sector is starting to really permeate every aspect of industry, consumer behavior, that's just going to grow and grow. And what's becoming very notable is the willingness of consumers to have their data collected and aggregated, whether it's Fitbit sensors or Apple Watch type data, through to a lot of their other behavioral data and so on. And so a lot of data is being aggregated. Every industrial machine has multiple sensors. Every aircraft has got a growing number of sensors that are measuring every aspect of that. Every tractor in a farmyard, is collecting data about its own performance, the crops, some of the kind of soil characteristics. And this is all now being aggregated in growing but already enormous data lakes where you can apply analytics tools. And what's going to change is our ability to predict. So the granularity with which the maintenance cycle on a tractor component or an aircraft part, or the driving patterns for autonomous vehicles, the granularity of the predictability will get better and better over time. And you're seeing the technology infrastructure that will support this becoming more and more effective and efficient. And so, I saw pictures recently of high density supercomputers, and NVIDIA, which is one of the big players in these high heavy duty processors now. They've got a supercomputer that fits into a rack. 15 years ago, that would have occupied an entire data center, that compute capability. So you can imagine that what we can deploy at the edge of networks, and this is a big talking point as to what lives where, but the amount of intelligence that we can have distributed around the country and around the world, even in rural locations, is growing quite fast. So everything is becoming highly, highly automated. The amount of usable information that's being generated by that is growing, and we're going to become more and more dependent on that, whichever segment you're operating in, to make your business or your own personal activities more efficient. And it's an incredible trend, but one that is unstoppable, it seems. And if you look at the connected device forecasts out there, a few years ago, people felt 20 billion was an excessive connected device number. Today we're already shooting for 50 billion in the next year or two, and that's going to double. And we haven't really seen the impact or the contribution of some of the emerging markets. There's been some analysis published very recently showing that some of the African countries are going to becoming superpowers in terms of population and how much of the global population they represent, but also GDP. Nigeria going from a population of 206 million to a multiple of that, becoming a real force in terms of global population. So, and the smartphone trends in Africa and content consumption trends are very, very strong. And a lot of their banking is already mobile because they never had the luxury in many of these African countries of laptops and capable machines in banks and so on and so forth. So they've grown up with a smartphone first environment. So it's going to be a fascinating decade ahead. But I certainly feel that the role of technology is going to continue to expand within our overall lives and economy.
So Milan, you've had the benefit of being on both sides of the trade in the financial markets, on what we call the buy side as a fund manager and the sell side as a broker. What do you think the value of research is, and what's the real difference between good and bad research?
Good question. Very subjective, but I think good research is about providing a real understanding of the business in depth. What I've found is over the last 5 to 10 years, and I think some of this is driven by the constraints and impact of MiFID, in terms of changing the monetization models for research and so on. But the amount of resources being devoted to research is clearly shrinking. And the quality of what's being produced is waning, in essence. And I think the experienced analysts who are able to provide that context and real understanding of the fundamentals of a company, having spent a lot of time talking to people within these organizations, visited their operations around the world and so on, that's a diminishing feature of what's available from the research product today. And that's a shame, because that's what you need in place to really open doors to the larger investors who are faced with an enormous array of investment opportunities. And companies that have a good story to tell are finding it more and more difficult to use research in the traditional manner that it was produced by the investment banks to access those pools of capital. And more, what MiFID means is that companies have to become resourceful in terms of how they get their messages across. Now, if I turn on my TV today and watch CNBC or Bloomberg TV, I'm going to see, CEO after CEO from the mega cap stocks coming along to talk about their story. Likewise, you open up the FT, lots of profiles of these mega cap stocks and what makes them tick and so on. But if your market cap is below 100 million, you probably don't have that opportunity very often, and you are potentially falling into the unloved category where very little is being written about you by banks or any other type of publication. So how do you get your story out? So it's a real time for management teams to think quite carefully about how they engage with investors, how they get their story out, against a backdrop of these challenging times.
Okay, Milan, let's wrap it up there. Thank you very much for your time and the insight that you provided on the sector. And to everyone out there, please like and subscribe to our YouTube channel, and we'll see you on the next one. Thank you very much.
Thanks, Keith.